Okay, hi everyone. Thank you for those who joined us earlier for patiently waiting for us to start the session. Before we begin, just some quick introduction to myself, Argus Global, and some administrative matters that we would like to just talk about. So, number one, welcome, as I said before, and again, we've received excellent response from everyone for attending this session. I'm Nithi. I'm currently the Director of Compliance for Argus Global. A little bit about myself. I've been in the compliance consulting space for the last 15 years with other consulting firms as well. And prior to that, I have done compliance work with in-house companies and banks as well. And a little bit about Argus Global. Argus Global is a regulatory compliance consulting firm that has been primarily assisting asset managers in Singapore. In general, we help companies to obtain their MAS license. We help to draft policies, procedures. We provide outsourced compliance support to licensed regulated entities in Singapore. We conduct internal audit, gap analysis, and pretty much we cover the whole compliance spectrum. So effectively for today's session, before we begin some admin matters, please help to put your questions in the Q&A section, and we will try to address as many questions as possible at the end of the session. And another thing is, please note that all of the participants will be placed on mute. And we will be providing the links to our slides as well. If you did not manage to get the slides prior to the training, we will be also sharing with you the link for our online quiz, which you would have to complete at the end of the training. And you have to input your registered email address in the quiz, complete it and submit to us latest by Monday. Upon successful completion within a week to 10 days, we will be sending you your training certificates via email. So I think that's it for my administrative matters. We can jump right in. Okay, so here in this slide, I have outlined briefly the scope of what we're going to be covering for our training today. So we begin by giving you the international regulatory overview of the international regulators that you need to be aware of. And then we'll touch a little bit on sanctions, why it's important, what kind of sanctions you need to be aware of. Then we'll go into specific Singapore rules and regulations, understanding basics of AML, KYC, what you need to do for risk assessment, suspicious transactions, and then at the end of it, we will touch on some of the recent MAS regulatory updates. So before we really deep dive into AML training, I thought it would be a good idea to give everyone like an overview of what's happening in the world right now. You know, how companies and banks in general, large financial institutions are dealing with AML. What is the sentiment about money laundering and you know, targeting money laundering at the moment in the world? So I've picked up some of the recent cases, and I think if everyone has been watching the news, you would have noted about the FinCEN files that was leaked recently. So basically, FinCEN file, just to give you an understanding for those who are not aware, it's basically documents leaking about 2 trillion of transactions, of suspicious transactions that have been reported by banks all around the world to the Financial Crime Enforcement Network of the US. And this is also includes Singapore banks, UOB, DBS, OCBC, to name some of the banks that were mentioned in the FinCEN files. And it was also interesting to note that Singapore had US 3 billion of suspicious transactions that were reported and had entered into the country, and $1.5 billion of suspicious transactions that were reported that had left the country. So I think this kind of sets the tone. And on the right, I've also highlighted other recent cases of leaks that we have seen in the media, all pertaining to different types of AML banking secrecy relating type of issues that have been reported in the media. In this slide, what I've shown you is effectively the type of penalties that have been meted out. And if you see the trend these days, AML penalties from 2019 all the way to, 2018 to 2019 to now, you can see that they have doubled. So what this means is regulators are definitely looking into meting out AML punishments quite vigorously. Penalties have increased, and it is no longer just a case of just well-known or established regulatory institutions or international countries that are looking at penalties. Penalties are now prevalent in all types of countries for AML-related incidences. And the penalties are primarily due to deficiencies in KYC, customer due diligence, and for lack of monitoring of suspicious transaction procedures. In this slide, I have just taken two examples of very recent cases where MAS has penalized Singapore companies for not meeting AML KYC requirements. So these are primarily Singapore companies with consequences that have been shown for not meeting the Singapore rules and regulations pertaining to AML. And if you see the punishment, or rather the penalty, has been also placed on the individuals responsible for the company. It is no longer just looking at the penalties imposed on the company itself. Okay, so let's go to the first topic, which is the Financial Action Task Force. So for the next few slides, we will be looking at some of the major regulatory bodies, which kind of frames and gives us the understanding of AML before we go into the Singapore regulatory landscape. So Financial Action Task Force, as what I call FATF, is effectively an intergovernmental body. What they do is they set standards, they develop, promote policies to effectively counter money laundering, terrorism financing threats. So what they do is they do assess different countries' AML policies and procedures. They compare it against the standards that they have developed, and they will determine if the countries are meeting those requirements. If they are meeting those requirements, most of the countries will then be invited to join the FATF as a member country. FATF has issued 40 sets of recommendations. What are recommendations? As I said earlier, these are basically guiding principles or standards that the countries should be adopting, and ensuring that their own country laws and regulations are drafted to comply with these global standards. And countries, as I said, who are compliant with the standards will be classified as members. And of course, there are also countries which are classified as other monitored jurisdictions and high risk, where these are countries to be called for action. What does that mean? It basically means that you should not be having any clients from Democratic People's Republic of Korea and Iran. And if you do have clients from the other monitored jurisdictions, as in the table that I've shown in the slide, you have to ensure, first of all, determine if you do want to take on the client. Number two, you have to conduct what we call enhanced due diligence. So these are some of the key things that we will discuss later on in the slides, but I just wanted to give you an oversight of why FATF is important. So Singapore is a member of FATF. So if you have a client who comes from a country which is a member country of FATF, it basically means that the country risk of that particular client is classified low. I just want to emphasize that it doesn't mean the client automatically becomes low, but one of the factors that you look at which is the country risk of a client, will be typically classified as low for just that one category. Okay, in this slide, I thought it would be good to just share with you that FATF did a visit. They did some evaluation on Singapore in September 2016. This is a regular practice that FATF does. Every couple of years they go back to the member countries as well to make sure that recommendations that they had provided in the previous evaluation, whether they have been met, whether they have been improved. This is what they do. So during the evaluation back in 2016, there were some recommendations that FATF had provided to Singapore, and I've listed some of the key ones here. The first one is that they felt that Singapore did not sufficiently reflect the connection between transnational threats, inherent risk and vulnerabilities pertaining to money laundering in Singapore. They also felt that given Singapore's unique geographical location and its status as global financial institution, there was definitely a lack of understanding of what terrorism financing means or how it impacts the financial institutions. And they particularly showed a lot of focus on the non-financial sector companies, such as the lawyers, the accountants, the real estate agents, where they felt that AML KYC was not exactly developed in terms of their understanding, especially around terrorism financing risks. So subsequent to all of this type of recommendations from FATF, Singapore government, with obviously the different regulatory authorities, including MAS, have worked together to make sure that they have made improvements, they have made steps to ensure that before the next evaluation happens, that they have met some of these recommendations. The next big regulatory body that I wanted to highlight here is the UN Security Council. So the UN Security Council, what it effectively does is it imposes targeted financial sanctions against individuals, entities, which are identified as threats. So anyone who's a member of UN must adhere to the different sanctions that UN has imposed. So Singapore, as a member of UN, is compulsory to make sure that financial institutions regulated in Singapore have to comply with the UN sanctions that they have imposed. So you have to ensure that companies who are regulated, if they come across any instances where there's any money that they hold that potentially is a targeted sanctioned individual or an entity related transaction, you would have to ensure that the money is frozen. That means you do not do any movement of the money. You would have to ensure that the appropriate reporting is done to the MAS, as well as any other regulatory authorities who request for the information. They will then advise you what needs to be done. The next important regulatory body is the US Treasury Office of Foreign Assets Control, the OFAC. So the OFAC is part of the US administration. What it does is, again, similar to the UN, it effectively administers and enforces economic trade sanctions against different countries, terrorist organizations. What I want to highlight here is the OFAC is primarily driven by political agendas as well, by the US government. However, what's important to note here is US being a big superpower, and given that US dollar is transacted massively, the OFAC kind of extends to all US persons. And US persons, definition, or rather the extent, is quite wide. It captures any US citizens or permanent residents. It includes US companies, foreign branches, subsidiaries, and foreign company with branches or presence in the US. Okay, so because it's so far wide-reaching, what we find is that Singapore companies are not exempt from complying with OFAC sanctions. I have listed out here some examples of Singapore companies that have been fined for breaching OFAC regulations. And you know, as recent as 2020, if you see the last bullet point, Singapore national was designated by OFAC and placed on FBI's most wanted list and was charged for falsifying documents and helping to hide transactions. And very much recently, Flex Limited, a Singapore-based electronics manufacturer, was also, they did a voluntary disclosure of possible non-compliance of US sanctions by certain non-US companies affiliated with Flex Limited. So they had a voluntary disclosure. I guess they wanted to show cooperation with the US regulators to make sure that the implications are more favorable. So given the broad reach, as I said, of US sanctions, Singapore companies, Singapore regulated financial institutions have to be aware of what are the OFAC sanctions that are out there. They would have to ensure that they are screening their customers and making sure that they are not breaching any of the OFAC sanctions as well. Now, next is Singapore sanctions. So we've looked at UN, we've looked at OFAC, which is US. Of course, Singapore has its own set of sanctions as well, which is governed by the Terrorism Suppression of Financing Act, where different individuals, entities from countries such as Democratic Republic of Korea, Congo, Iran, Libya, Somalia, South Sudan, and Yemen are targeted. We've also got the Al-Qaeda list and the Taliban list, which is basically the sanctioned list provided by the UN. And it's all found in the MAS website, and you can access all of these lists from the MAS website as well. Again, a reminder for financial institutions like yourselves, if you come across any sanctions, you must immediately freeze the funds or any other assets, not enter into any other type of financial transaction or any other services. And you have to inform MAS of all facts and information relating to the entity or individual and determine what is the next right appropriate action that you would have to take. So before we go into the next slide, I do often get this question asked a lot. You know, there's so many sanctions, right? There's OFAC, there's UN, there's Singapore sanctions. How does one make sure that you're not breaching any of these sanctions? Do we individually search through the websites? How do we comply with it? So the most common way, and as what MAS has also reflected in the AML notices and guidelines, companies can use a screening tool. There are quite a few out there in the market. And these screening tools, what they do is they have taken all the relevant data from the different sanctions available in the domain, and they have compiled it together, and you have one place where you are able to put a name of an individual, a natural person, and that will show you whether there's been any sanction against that individual or the entity. So that is how majority of the companies are making sure that they're screening against these sanctions. But I should highlight that it's not enough to just screen against the sanction. Of course, if you do get a hit, you should investigate it further. You may even require to get legal opinion to make sure that, you know, if you do come across a potential hit, is this a real hit, and how do you ensure and handle that particular hit that you have come across? Okay, the next few slides, we're going to touch briefly on what is money laundering, what is terrorism financing, and then we'll go on to specifics of Singapore rules and regulations for doing client due diligence and risk assessment. So in this slide, I'm sure all of you guys have attended numerous money laundering trainings in your life. So I will not bore you too much with it, but I think what I wanted to try and get out of the next few slides is to help you understand that money laundering effectively requires you to have done an underlying crime. So you have to have done a crime, and then in the process of cleaning the money you get out of doing the crime is also then considered as a crime. So there are multiple, there has been an underlying crime that was committed. So if there's no crime that was committed, effectively you can't really, say that you have laundered money. And I've listed here some of the major crimes out of which you can you will get some of money which you then try to launder for you to then use the laundered money legitimately. Okay, there are 3 stages in money laundering. You have the first stage, which is placement. So for example, if you had done a bribery act, you got a bag of money. Obviously, you can't just keep it under the pillow. I mean, I guess you can, but if it's large sum, you have to find a way to put it into the financial system. So most people will try and find ways to place the money first into the financial system. That's the most critical part of it. So they will go to the banks, they will go to fund managers maybe, they will go to insurance companies, they will try and do a transaction to get the money into the financial system. Once the money goes in, then the next stage is called layering, where they will carry out various transactions and create a huge distance between themselves and the original source of money. So this is where you will see multiple companies involved in doing different transactions, companies in different countries doing transactions. You have different individuals employed as money mules even to do different transactions. Eventually, it will create a web of transaction that it almost becomes difficult to trace it back to determine where did it originate from. Once the person who initially placed the money managed to layer the funds and they get the money back, they are then able to inject the illegitimate funds back into the society by way of doing a transaction or setting up a business. Like, if they set up a legitimate business, the funds basically become part of the economy. Or if you send your kids to school and you pay for such tuition, that becomes legitimate funds back into the economy. So this is an entire cycle. What we also have to understand is the best time, or rather the when you can really detect money laundering is at the placement and layering stage. Of course, when it comes to the integration stage, it's almost impossible to even know whether this was laundered money in the first place or not. So most fund managers, regulated companies are often targeted during the placement and the layering stage. I would say more so on the layering because a lot of them still prefer to go to the banks to do the first placement and then use different types of financial institutions to create a web of transaction. In this slide here, I've kind of just given a quick diagram of how it can even work. So you've got the individual who deposits the illegal money into the bank. They then withdraw it. They go to the casino. They purchase some chips. They then redeem the chips, and they get basically a clean check from a legitimate legal business, which they then deposit back into the account. So of course, if they put in $1 million of illicit proceeds and they clean the money, all the money launderers know that they're going to lose some money anyway, but it doesn't matter because at the end of it, they're going to get clean money, which they can use. What is terrorism financing? So terrorism financing basically is an act of using funds and providing the funds to terrorist groups so that they can carry out their criminal activity and terrorist activity. One thing I wanted to highlight here is that the key difference between money laundering and terrorism financing is that in terrorism financing, you do not need to have done a criminal activity first to get the source of funds. The funds can come from legitimate sources, such as donations, can be, for example, your salary for individual. Perhaps you support a certain terrorism organization's motive and goals, and therefore you fund their operations, and that itself is still considered as a terrorism financing act, even though the money is a legitimate source of funding. Another thing interesting to also note is that what's classified as a terrorist group, it does to a certain degree vary from country to country. So there are certain organizations who are classified as associated with terrorism activities, whereas in certain countries, they're not classified as terrorism activities. So whenever, again, how do you know if there is a potential hit for one of your customers in terms of terrorism financing? When you do screenings, again, look into the hit, understand why the hit came about, and if you're not sure, you need to speak to the appropriate legal counsel to help you understand, is this something that is truly a true match of hit for you to then take action in most cases, which is that you do not go ahead with the transaction. Here, I've just pulled up a quick case study. This is an example of how a web of transactions are done. So A makes an investment in a fund. While withdrawing the amount, asks for the money to be deposited into someone else's account. B then makes a separate investment, and while withdrawing, gets the money credited to another person's account. So this, again, is a process whereby, a web of transaction is created to the point that it becomes difficult to trace back. So to counter this problem, in most cases anyways, in the fund management space, you should only allow money to be transferred back to the same entity or person who invested with you to that account that they have provided. If there's any deviation to that, that requires to be investigated and looked into properly, and as far as possible to be avoided. And then in this slide, I've just given another example here of the famous, 1MDB case. This is another example of layering of money laundering proceeds. So you can see, multiple intermediaries were involved, different countries were involved, different organizations were involved to launder the large sum of money from the 1MDB case. And as we all know, different banks, including Singapore banks, were also highlighted in the process of investigation during this case. Now, what are the consequences of money laundering? I think we've kind of touched briefly, we looked at the international regulatory landscape, we looked at sanctions, we looked at, briefly, Singapore requirements, which we will touch on in more detail later on. But I think, as a financial institution, I think it's important to really understand why do we care so much about money laundering? Of course, everyone is worried about getting fined by the regulators, that you're not meeting the AMLCFT requirements and the notices, the guidelines. That is typically the tip of the iceberg, as I call it. That's what everyone is mostly worried about. And then if you think about it further, if you're not compliant, you do have other tangible, type of consequences. You would have to spend more time to deal with your MAS inspections and reports to rectify the gaps, which may mean that you have to hire more people, you have to invest more money, you may have to get new technology, screening tools, etc. And then if you think about it even further, when you have serious breaches like what I showed you earlier on, Singapore government is going in the direction of name and shame, where if you had done a breach, if a penalty has been issued, you will be shown on the MAS website. So anyone can Google your company name and find out if you have had any serious AML/KYC breaches. So that effectively causes reputational damage, and then that leads to loss of clients, and loss of new investments. So I think it's important for everybody to understand that, AML shouldn't just be looked at it as a silo thing. It is an integral part of your business because it helps to protect your business, and it does help to bring in more business because increasingly large institutions as well, they want to ensure that your AML KYC processes are tight, they are compliant with the local rules and regulations before they decide to invest money with you. These are all part of the due diligence questionnaire that they often ask and the process they often undergo with potential fund managers. So I think, it's important to have this at the back of your mind and really understand why, certain processes are important. And those processes are important because of these reasons. Okay, now we're going into the specifics of Singapore rules and regulations, where we are going to start looking at KYC AML requirements. But before that, I've kind of highlighted here what are the key notices and guidelines that we should be looking at. So you've got the MAS notice for prevention of money laundering, countering financing of terrorism, and the guidelines in relation to the notice. You've got the Corruption, Drug Trafficking, Other Serious Crime Act and the Terrorism Suppressing or Financing Act. You've also got the notice on reporting of suspicious activities and incidents of fraud. So when you're drafting your AML policies and procedures, it's important to make sure that you have read through all of these different acts, notices, guidelines, and make sure that your policies and procedures are adhering to all of these requirements. And then who's responsible? I would like to emphasize that the culture, the tone that every company sets is extremely important. As you will see that, in recent cases of penalties issued out, if the tone from the top in terms of the standard that the employees should adopt when it comes to preventing money laundering, if that's not correct, then you will find that no matter how many people you employ, you're never going to meet the standards imposed by the regulator. So responsibility for AML KYC is everybody's responsibility, is everybody's role to do their part. Of course, board and senior management, they are mostly held responsible by the regulator. So the CEO and directors are held responsible for the company's inability to meet AML KYC requirements. Compliance officers, compliance team, they are also playing a role as second line of defense, where they will have to ensure that there's appropriate implementation of policies and procedures. And then you've got the third line of defense, which are your internal auditors, your independent reviewers, consultants like us, and also such as your external auditors, where they come in, they inspect your books and records, your supporting documents, and give you recommendations as well as to whether you're complying with the relevant rules and regulations in Singapore. So again, just to emphasize, it's everybody's responsibility, everybody plays a role. However, the CEO and directors are ultimately held responsible. Even if you do outsource your compliance, AML or KYC, to any third-party service providers like your fund administrators or to a service provider like us, you would still be held accountable and responsible for any lapses that the regulator finds in looking at your books and records. So this is basically what I've just mentioned. The last bullet point, individual accountability standards. I've just put this in here. I think everyone might be aware there is a consultation paper out there for Singapore to implement individual accountability standards. This is very similar to the senior management regime in Hong Kong, and the FCA has a similar regime as well, where increasingly the regulator is looking to make sure that individuals who have senior management functions or risk management functions within the organization must be held accountable if there are any potential lapses or breaches in that particular area. So what you're going to find is that increasingly Singapore government, the MAS is going towards a direction where no longer is it just the company that's going to be held accountable for any breaches, but they're going to really look at who within the company, besides the CEO and the director, who else was responsible for that particular function had failed to perform what they're supposed to have performed in order to prevent that breach or the lapse. Okay, so in this case study here, I thought it was good to just point this out and show you. A lot of these case studies, just to let you know, these are all actual cases that we've come across where, you know, we find that it's useful to show it here so that everybody kind of understands, you know, where we're coming from. In this particular case study, the financial institution had one local compliance headcount to manage the group compliance matters, including Singapore matters. But because the group was had its own policies and procedures, there was a lot of emphasis for everyone to follow the group policies. There was not much attention given to Singapore requirements, particularly in the AMLCFT area. I think for those who have offices in different jurisdictions, what you will find is that the general idea of AML KYC can be the same, and it should be the same in most countries. But when you look into the nitty-gritty details of, you know, of what you're supposed to do for AML, such as, you know, what kind of documents you should collect, whether you can do different types of due diligence methodology for your clients. There will be slight differences between different countries in how they practice AML and KYC regulations. So it is very important to make sure that if you are handling more than one country, and if you are not just particularly looking at Singapore requirements, you have to still be familiar with the Singapore requirements and make sure that anything that you're doing in terms of procedures for AML, you are 100% adhering to Singapore standards as well, on top of whatever group standards that you're complying with. And what I sometimes find is that sometimes companies have group compliance manual or group AML policies, which is fine. But sometimes, again, these policies are not really addressing some of Singapore-specific requirements. And therefore, when you do get inspected by MAS or by the statutory auditors, the external auditors, they will bound to find some points saying that, you know, there are insufficient procedures around certain areas for complying with Singapore rules and regulation. So it's always a good idea to map whatever group policy you have against your local requirement here in Singapore. And if required, you can put something called an addendum to your group policies, which specifically spells out the additional things that you would have to do for the local requirement here. And then the next few slides, I thought it would be a good idea to touch on risk management framework. Risk management is quite wide. Effectively, MAS is looking to make sure that companies identify, address, and monitor risk associated with the customer assets. This is provided in the fund management guidelines as well as in the various regulations. All fund managers are expected to have adequate policies and procedures in place to show how they will manage the various risks that they face. And the framework should, you know, minimally look at governance, independence, competency of the risk management function. It should help to identify and show how you're going to manage your risks, what kind of tools you're going to be using to track these risks, especially those associated with customer assets. So you should effectively have a framework in place where you've picked out all of the risks that you feel are affecting your firm or will affect your firm, the impact to your business, and the frequency of how often these risks will happen, which will eventually allow you to determine which ones of these risks are high, medium, or low. And subsequently, you have to then implement appropriate controls to manage all of these different risks. And timely monitoring, reporting of the risk to management is very, very important. so that immediate rectifications or appropriate rectifications can be undertaken. And documentation of policies, procedures, and reports, again, are very, very important. It is important to not just have a risk management framework, but you also have to show what are the controls you have implemented and supporting evidence to show that you have done some of the checks and balances to mitigate or control some of these risks that you have identified. So the key thing here is to have the supporting documents. One of the areas in terms of risk management, in terms of why I brought up risk management, is because of the need to do enterprise-wide risk assessment. So there are two risk assessments that you have to bear in mind and think about when it comes to AML KYC. Number one is enterprise-wide risk assessment. Number two is customer risk assessment, which I will come into later on. So enterprise-wide risk assessment, EWRA or ERA, effectively is, in simple terms, it is for financial institutions to understand how risky they are for money launderers to use them to launder money. So in order for you to make the risk assessment of your organization, there are effectively 4 factors that you would have to look at. The risk in terms of your customers, risk in terms of countries, jurisdictions where your customers come from, in terms of countries or jurisdictions where you as a financial institution has operations in, and then lastly, the products, services, transactions, delivery channels of your business. And entities are required to consider the national risk assessment results when identifying and assessing money laundering and terrorism financing risks. Now, what do I mean by customer risk? Basically, if you have a lot of politically exposed persons, if you have a lot of clients who are in the casino business, for example, that would mean that your customer risk is quite high. If you have a lot of clients coming from FATF monitored jurisdictions, that would mean under second bullet point, your country risk is high. If you have a lot of clients, if you have a lot of operations like subsidiaries or other holding companies in high risk jurisdictions as reflected by FATF, then again, that makes your overall enterprise-wide risk assessment high. And then lastly, if, for example, if you deal with a lot of online transactions, or if you are in the business of higher risk type of products as classified by the National Risk Assessment Report, such as crypto trading, then your product, services, transaction, delivery channel, particular risk is going to be classified as high. So this is how, in general, you need to do an assessment. You need to come up with a framework with these 4 parameters in mind, and eventually determine what is the overall risk that you have assigned to your organization. It is not important to just identify the risks. You also have to then determine what kind of controls you're going to put in place to mitigate and lower down your risk eventually. So this is a key thing that MAS expects all organizations to carry out. So under the National Risk Assessment, you can Google and download this report. It's available online. This will give you an understanding of what kind of customer sectors are considered to be high risk. Fund managers are definitely not classified as high risk under financial sectors, but definitely the remittance, stored value facility holders, corporate service providers, pawnbrokers, casinos, these are all types of sectors that are classified as high risk. So if you have any clients from these sectors, they should be treated as high risk for that particular category. You would also have to include a higher risk crime type of activities when you're doing your risk assessment. So these are the different type of threats that Singapore government has identified. Okay, the next key thing is called product due diligence. So as part of National Risk Assessment, Financial institutions also must ensure that every time they introduce a new product, or they're going to deviate away from their business plan or business strategy, they should do a due diligence on their new product to make sure that they are aware of the AML KYC risks pertaining to the product before they start doing business in that. And it does potentially require a notification to MAS if it's markedly different from your existing business model. I find that a lot of companies often forget to do this particular due diligence activity, which I thought it would be a good idea to remind everyone at this point that this is, again, part of enterprise risk assessment. So how often should you do it? You should do it once, at least every 2 years. You have to make sure that the report goes to senior management, and senior management is aware of the various risks and the controls, as I mentioned, that you're going to be putting in place. And the EWRA also needs to be approved by the board of directors. So it can't just be a document that you produce in-house but doesn't get communicated to the senior management, which includes the board of directors. They have to be aware as well. What are the obligations of financial institutions? So just to tie into what we have said so far. So we've looked at the general rules and requirements. We've looked at why AML KYC checks are important and why financial institutions have to pay attention to it. Now, how do we show as a financial institution to the regulator that you're complying with the various notices, guidelines, and the rules that Singapore government has set up? That is basically done through your due diligence procedures. So as a financial institution regulated, there are 4 main things that you would have to do. You would have to do due diligence when conducting business. You have to conduct your business with high ethical standards. Make sure that you are not undertaking transactions connected to aiding money laundering or terrorism financing. You have to assess the risk of opening account and relationships for each customer based on the business type and country of origin. And lastly, you must monitor your accounts for suspicious transactions and report to the relevant Commercial Affairs Department authority and to MAS. So in this next screen, I have kind of broken it down into these stages. When it comes to customer due diligence, I have highlighted here 6 key things that you have to do for your customers. And you have to do this entire process in order to ensure that you are complying with the various MAS notices and guidelines. Okay, so the next few slides, we're going to be going through each of these process as I've highlighted here. When should one do customer due diligence? So everyone knows that they must do CDD when they establish business with their customer. Ideally, you do it before you establish the business with customer. I will show in the next slide what are some of the parameters that you should keep in mind. A lot of firms forget to understand that periodically they also must carry out due diligence. That means it's not a one-time affair that you do. That means when you first get the business, you do the due diligence and you do all the necessary checks and then you keep it in file and then you forget about it. You have to repeat customer due diligence at different times. One is when you suspect there's money laundering or terrorism financing. Number 2, you have doubt on the information that you had previously obtained. So no longer what you have in file may be accurate. Number 3, you have to periodically carry out due diligence in accordance to the risk of the customers. So the risk of the customer is something that we'll touch on later on, but effectively, all of your customers should be ranked into different risk categories. Namely, what we see, there are 3 main categories: high, medium, or low. Some companies only have high risk or low risk. That's also fine. But you must rank your customers according to risk, and that will then determine how often you carry out the due diligence exercise for your customers. Okay, so generally, as I said, you have to complete your verification of your customers before you establish the business relations or you undertake the transaction. Of course, if you can complete, if you need to complete the verification later on so as not to disrupt the business normal conduct, you can do so. But there are certain timelines that you should follow, no later than 30 days after establishing the business relations. If you have not completed the whole KYC after 30 days, you're supposed to suspend the relations and you must terminate the relationship if you haven't completed it within 120 days. Okay. When you're doing the CDD, if you recall the 6 things that I mentioned, the first 2 things that you have to do is called the identification and the verification. Now, simply put, identification means it is the process of getting all the relevant information onto your account opening form or your subscription document. What's the client's name? What's the name of directors? What's the address? You basically identify your customer, who they are. You also have to identify other related parties, the natural persons who are acting on behalf of the customer, and the beneficial owners of the customer. So in a case of a company, you would have to identify details pertaining to the company. You have to identify any related parties to the company. Natural persons effectively means any directors or authorized signatories who have acting power of the company. The beneficial owners basically refers to the natural person who effectively eventually owns the company. So a company can have multiple layers of in-between holding companies, but you have to find out who eventually owns the company right at the end, and it is always a natural person. Okay, in this slide I've showed some examples of what kind of information we obtain. And then the next question is verification. So once you have identified all the information, the next step is to verify the information that you have obtained. And that is through the supporting documents from government issued documents, such as the passport copies, the proof of address from utility bills, etc. And then for legal documents, it would be like the M&A, the merger acquisition, sorry, the memorandum and articles of association document, the director's passport, the director's proof of address, the authorized signatories, and then eventually the ultimate beneficial owners verification documents. So you have to look at it as identification and verification, and that entire process will be called the identification and verification process for your customers. It's important to make sure that you are verifying your customers with reliable independent source, as I mentioned, usually government issued documents. If you get your customer giving you something in writing that, you know, this is where I live, or these are my list of directors, you can't just accept that because this is not independent information provided to you. At some times, if you can find 2 independent secondary sources from the internet, you can use that as one primary independent source as well to verify an information. Who are related parties? For legal persons, the directors, natural persons who have executive authority. Partnerships are partners and managers. For arrangements such as trusts, any natural person having executive authority is typically classified as a related party. Any natural person on whose behalf a transaction is conducted. Again, these are also classified as related parties. Who are natural persons? As I mentioned earlier, these are all the directors, the shareholders, authorized signatories, and anyone else who has the authority to act on behalf of the company who might be your customer. Beneficial owners, as also I mentioned earlier, is referring to the natural person who ultimately owns or controls the company. In the case of a trust, we have to identify the settlers, the trustees, the protectors, the beneficiaries, and any other natural persons who have ultimate control over the trust entity. So this I find that has been increasingly difficult, or rather, we find that a lot of companies are facing a lot of issues meeting these requirements, because this was a pretty stringent requirement that was introduced by the MAS. And then this slide, what I've highlighted here is that MAS and ICRA does allow you to use a threshold for ownership criteria when it comes to identification and verification. And that is anyone owning more than 25%, you should be able to identify and verify. And again, the threshold does not apply to natural persons who have ultimate control. So if you only have 2 or 3 person with owning more than 25%, of course, you have to identify all 3 natural persons who have ultimate control over the customer. When do you not require to do screenings or identify beneficial owners? I will touch on this later on, but I will just mention it here. Effectively, if you are dealing with a listed company or a regulated financial institution, there's no need for you to identify and verify beneficial owners. So there are certain criteria if you are able to take. You are able to do something called simplified due diligence, where you don't have to do what I've just described in terms of the depth of doing the identification, verification on all of the directors, on all of the beneficial owners, on the shareholders, authorized signatories. You can reduce the due diligence that you're doing and definitely not be required to do a CDD on the beneficial owners for low risk customers. We will come to that in a bit. Okay, so we have covered identification, verification. What is the next step? So you've collected all the documents, you have verified all the documents. Then what do you do next? You have to do something called AML screening. So this ties in with what we discussed much earlier on in the presentation, which is the requirement to comply with UN sanctions, the requirement to make sure that you do enterprise-wide risk assessment. You have to ensure that you do AML screenings to find out if anyone you're dealing with is classified as a high-risk customer. So how do you do the risk assessment? You have to, as I mentioned, use some sort of screening tool which is available in the market, and then screen them against the tool, which will enable you to produce a report which you can then show and support for your KYC folders. And that would enable you to also show to the regulators whether you have any hit for any of your investors or your customers. Okay, apologies, so we'll continue. So as I was saying, AML screening is the next step. You have to find the tool and do the necessary screening. At this point, I just wanted to mention, so I know a lot of fund managers use fund administrators to help them with this process. A lot of fund administrators help to collect the documents from the investors. They then do the screening, and they will then highlight to the fund managers if they come across any potential hits when they do the screening. And I think all fund administrators are using some sort of screening tools to do the screening. A couple of things to point out here. You must be clear in terms of what the fund administrator's process are in relation to screening, in relation to escalation of any potential hits to you, and whether they are going to help you do something called enhanced due diligence. So it is firstly important to understand what your fund administrators are going to do. So you must understand their internal policies and procedures when it comes to AML KYC. You must be aware how they're going to escalate the particular hit or high risk to you. You must understand how often they're going to be doing the screening for you, especially for high risk customers. And then you also must understand if they're going to help you do enhanced due diligence, which is a requirement if you have a high risk customer. And even before that, one of the things, even to determine what is a high risk customer, you would have to then again understand from your administrator, are they going to help you rank your customer, investor into the different risk category based on the different parameters. Now, AML screening results will normally tell you if a customer is a politically exposed person, if there's tax risk in relation to the customer, whether there's any bad press, whether the customer is, if there's a breach in terms of any sanctions. Other than that, in terms of doing risk assessment, which we are going to come on to the next few slides, you would also have to look at whether the customer comes from a high risk FATF country. You have to look at whether the nature of services and or the employment of the persons, is it of a high risk nature? These are other additional categories that you would have to consider before you rank your customer as high risk. So what I'm trying to say is you have to understand what is it that the fund administrator is helping you to do in relation to the screenings, the period of when they do the screenings, how do they escalate to you, do they help you do the risk assessment, and do they help you do enhanced due diligence. If they're not helping you with any of these, you would have to take it back and do that in-house. As I mentioned, the arrangement that fund managers have with the administrators is considered as an outsourcing arrangement, which means that you're not able to rely on what they're doing. The responsibility goes back onto the fund manager to ensure that whatever checks and balances done on the investors are all compliant with the MAS requirements. Okay. So this ties into what I was talking about earlier in terms of the enhanced due diligence requirements. So the identification, verification, the AML screenings, and the risk assessment, effectively, you can have three types of due diligence that you will conduct. The normal due diligence is whereby you identify and verify all the people that I've just explained, all the natural persons, in terms of the directors, shareholders, authorized signatories, and then the UBOs, who are the ultimate beneficial owners. So you do the entire process. That is what we call a normal customer due diligence. Then when you have a high-risk customer, say your client is a PEP, or you find some bad press on one of the directors, or the customer comes from one of the monitored jurisdictions, that would ultimately classify the client as a high-risk client. And then what happens is, when you have a high-risk client, you are required to do something called enhanced due diligence, which we will touch on what that means later on. Then if you have a very low-risk customer, you can do what we call the simplified due diligence. Low-risk customer, again, we will touch on in the next slide, effectively means that the risk of money laundering and AML KYC issues with that particular client is going to be extremely low. And usually there are only two usual scenarios. This is because the customer or the investor is a listed client or is a regulated company in a FATF member country. That means not just any country, but a FATF member country, because FATF member country is classified as low risk. Okay, so what is enhanced due diligence? You have to obtain additional information from more robust sources. You must conduct additional searches. You may have to get more reports done by independent parties. You must make an assessment at the end of it. Do you want to take on the risk within your organization for this particular customer? Or do you want to forego the transaction or forego the relationship and not have that high risk within your organization? When do you conduct this? When you have a politically exposed person, when you have anyone, not just one person, but you have to check on different natural persons. So if any one of the natural persons are a PEP, that makes the entire account high risk eventually. If you have, as I said, customers or UBOs from high risk FATF countries, or if you have customers coming from higher risk jobs or sectors, then again, the entire customer becomes high risk. And next slide, I've just given a brief in terms of who is classified as a politically exposed person. Effectively, this refers to any politicians or members who are closely connected to politicians. It's important to note that Singapore PEPs do not need to be classified as high risk automatically. That is one change that the Singapore MAS has introduced. Another reason why someone would be classified as high risk is because of tax risk. So tax risk effectively is designated as a money laundering predicate offense as well. So if you, during the process of AML screening, come across any potential red flag in terms of your customers for tax risk purposes, then these are these will make your customers high risk as well. What are some of the red flags that you should be aware of? For example, if client asks for wholesale services, they use complex tax structures. There are negative tax-related reports when you do screenings for your customers using the databases, or if your client comes from tax haven countries. These are all potential red flags that you should be looking out for when you're determining tax risk of your customer. So if you have a potential red flag on tax risk and that makes your overall customer high risk, you would then be required to do enhanced due diligence, as I've mentioned on this slide. Okay, so here I've just given another a case study where a Singapore customer has set up a Singapore incorporated investment holding company to pump money into an underlying company of a structure managed by a fund manager. The customer explains that they are injecting the funds directly into the new company to avoid potential queries from tax authorities where the money was generated. And they have also claimed that they are also a non-tax resident in the country where they are generating the income. Financial institution basically failed to follow up on the particular tax-related red flags during the onboarding, even though these information were present during the entire customer onboarding process. And they also failed to file a suspicious transaction report to the MAS and the CAD department. So here is an example of what a tax risk issue would look like. And a lot of the time, sometimes I get asked, there are legitimate ways that companies do tax structuring to minimize the amount of taxes they pay. So it is a thin line in terms of what is tax avoidance and tax evasion. Tax evasion is a crime, but tax avoidance is not a crime. So as a normal financial institution, you may not know the difference, but as I mentioned in this earlier slide, you can use all of these parameters to help you identify if there's a potential tax risk to your investors. You're not required to have the in-depth legal knowledge of whether they are doing tax evasion or tax avoidance. As long as you have some suspicion and there are some red flags that you have identified, you should be able to make a sensible assessment in terms of whether they are potentially showing tax risk, which then means that they are a high-risk customer. So what do you have to do for high-risk enhanced due diligence measures when you're dealing with high-risk customers? You would have to obtain more information on the source of funds and the source of wealth. So basically, source of funds is the difference between the source of funds and source of wealth. Is basically source of funds is where the investment money is coming from. You need to really be sure and clarify that. The source of wealth is basically understanding and having supporting documents to show why the customer is rich. Is it through inheritance? Is it through their business? how much revenue the business is earning, or is it through their personal investments, through the various broking accounts that they hold. You have to understand the basis of the wealth. Second thing is you have to obtain approval from senior management before proceeding with the business relationship or continuing with the business relationship. So you must ensure, and this is important to note, there must be a difference between your normal due diligence process and your enhanced due diligence process. You can't do the same. So if at the moment everyone is getting approval from senior management before opening an account for any type of customers, then how do you show an additional step for a high-risk enhanced due diligence customer? You would have to make sure that you look at your policies and procedures to make sure that there is a difference in how high-risk customers are handled. The last thing is make sure that high-risk customers are subjected to more frequent periodic checks, which basically means that you would have to look at all of the identification verification documents you have obtained, look at whether you need to ask for new documents, whether you need to ask for expired documents, basically to replace all the expired documents. If you have a corporate client who's high risk, for sure there will be changes that would have happened. So you need to go back to the customer and ask them for updated documents and verification documents. The next thing you would have to do is you have to repeat the AML screenings. Again, sometimes what I find is that some clients tell us, oh, there's no change, we've already done the screening, we didn't do a repeat screening. So that's incorrect. Even if there's no change, all the directors are the same, there's no change in UBO, nothing significant has changed for the company, you still are required to repeat the AML screening on the entity, on the natural persons, on the UBOs. And the reason why is because, over the period, someone could become a PEP or a high risk that you're not aware of. So you should do the AML screening and repeat it for your high risk customer. Then after that, what you should do is you need to update your CDD form. So in the CDD forms that you have for your customers, you should have an evaluation section where you either agree that the client remains high risk, or for whatever reason you think that the risk should be reduced, then you should put your explanation and have that approved by your senior management. So it is important to make sure that these steps are repeated, and also always tell our clients not to override your initial due diligence that you have done when it comes to periodic checks. And the reason why you should not override it is because you want to show the regulators that this is what you did for your initial due diligence, and then these are the additional things you have done, these are the new sets of AML screenings you have conducted, and this is the updated CDD form with our risk assessment to show why we have decided to still continue on with the business relationship. So I think these are things that you should bear in mind. And the next slide is talking about simplified due diligence. As I said, you can skip some of the steps, such as identifying UBOs and verifying them if you're dealing with government entities, listed entities, or regulated companies in an FATF equivalent standard, which typically means FATF member country. As I was just mentioning earlier, high-risk customers, you should be repeating some of the, obtaining some of the documents and repeating the checks. At the same time, we also need to make sure that you're doing monitoring of your customers' transactions, making sure that there's no unusual movement of money. They are not asking you to redeem the funds into different accounts. They are not suddenly making new subscription with large sum of money, which doesn't coincide with their background. These are things that you should pay attention to, and these are all part of your transaction monitoring process. And how often do you repeat your CDD for your customers? Basically, this is the general guide that we use. For low-risk customers, you repeat once every 3 years. medium is once every 2 years, and high is minimum 1 year. Excuse me. Okay, and besides during the periodic due diligence time, when you are supposed to do the check, other times also you should be doing checks. And when should you repeat some of the checks? These are called trigger events, when there are changes to the organization, like you read on the news for your customer that the new director is appointed, etc. That should prompt you to do a due diligence, repeat some of the due diligence on your customer. When also there are changes made to the list of sanctioned individuals and entities covered by the various regulations, that should also prompt you to do a repeat of the AML screenings. And normally, if you're using fund administrators and databases, they will repeat all of the screenings on a bulk screening basis. So normally that is captured through that system that they're doing. Next few slides, we're just going to touch a little bit on AML offenses and penalties. This is just to, scare everyone, I guess, but just so everybody is aware. So common ones is do not enter into any arrangement where you know or have reasonable grounds to believe that you are helping to facilitate the retention or control of benefits of drug trafficking or criminal conduct. The key thing I wanted to highlight here is reasonable grounds to believe. So when you have reasonable grounds, that's what the court and the law will try to establish. You do not need concrete proof for you to decide not to go ahead with a particular transaction because you suspect that they are doing illegal money laundering activities. As long as there's a suspicion, you should not enter an arrangement. You shouldn't wait for hard concrete proof. And that will not pass the court of law. Penalties: 500,000, imprisonment of 10 years or both, and company fine not exceeding 1 million. Tipping off is another offense. This is disclosing to customers knowingly or having either knowingly or unknowingly having reasonable ground to suspect that an investigation is taking place. So if someone has reported a customer to CAD, to MAS as a suspicious transaction, you should not ever discuss this and allow the information to go back to that particular customer. And mainly the reason why is we are trying to prevent the customer from fleeing the country. Because once you have done a suspicious transaction, you will not know as a financial institution if the CAD department is investigating that particular case or not, unless it is quite a public case, or if the CAD department comes back to you and asks you for particular transactions or information about the case that you've reported, then you know that they're investigating. But sometimes you don't know what is the outcome after you've done the suspicious transaction. So it is important to make sure that you're careful in terms of what action you take after you've done your suspicious transaction, and make sure that you're not in any way tipping off your customer. For example, if you close your relationship with a customer and you tell them that we are closing the relationship because we suspect that you're doing money laundering, I mean, you can't say that because that's basically you tipping the client off. So always be aware and make a conscious decision in terms of how you're going to deal with an investment that you already have for a particular client, if you have reported that client to MAS or to CAD for potential suspicious transactions. Okay, a little bit on SDRs. As I mentioned, SDRs are part of the Singapore SDRO is part of the Singapore Police Force, and any suspicious transactions typically need to be escalated to compliance. You must be aware and you must document in your policies the process for your employees to do this escalation. Within how many days they should highlight and escalate, and within how many days are you going to be reporting to CAD and MAS. So typically, once an employee, once a suspicious activity is identified, you must escalate the information to the MAS within 5 working days. There is a suspicious transaction form that needs to be completed and sent to the MAS. The next thing is you must report the STR to CAD department within 15 days after the escalation has been done. And if there's a case of a fraud that has taken place, you are also required to go to a nearby police station and make a police report. And the police report has to be submitted to the CAD department as well as the MAS officers in charge. All financial institutions, when you get licensed, they would require you to subscribe to the Sonar platform, so that you have the ability to log in and do the suspicious transaction reporting online. Employees should be made aware that if they suspect that the reporting officer or the CEO or director is also in cahoots with the client, and you don't think that the information will get reported, you can also go to the CAD department and you can also lodge your own suspicious transaction, basically via fax, email, and you can even write in hard copy to inform them. Here's a case study where we have highlighted 2 examples of potential suspicious transaction. You have a customer, 32 years old, net worth 2 mil, primarily from employment, and primary residence is 1 million, investment property 900, cash and investments 100,000, initial investment 700,000. Case study 2, a senior executive in a country for more than 20 years has an annual income of that amount, and the declared net worth is around 100 million. So you can see that the source of investments are not very clear. The profile of these clients do not really, match the investments that they are holding. So this is a classic example of making sure that the client profile matches the transaction, or rather there's no real disparity between the investment pattern versus the profile of the customer. So underlying thing is you must know who your customers are. You have to ensure that you are completely aware of who they are. You have all the supporting documents, and you have satisfied yourself of all the potential risks that you can take on board if you have the particular customer on board as your investor. You must ensure that you're able to justify to the regulators and to the external auditors if any issues come up with any potential cases in relation to your customers. It's always important, and I can't stress this enough. You must document everything you do. If there's anything that requires more explanation, you should be able to do a file note. A file note is effectively just an addendum where you are able to explain, expand, and write in detail case notes about your particular investor if it's required. Make sure that all forms part of your customer due diligence folder for your customers. Again, here in this slide, we have showcased symptoms of an investor. Being engaged in money laundering. Some examples for fund managers. Normally, if customer, refuses to give you information that you've requested for, they're refusing to give you supporting documents. They are very eager to invest with you without really understanding what they're investing in, what are the risks involved. They subscribe and they redeem from your funds very, very quickly and no reasons in terms of why they're doing it. Or the other example, as I mentioned earlier, they subscribe into one account, using one account, but they redeem or request to redeem to a different account. These are all potential suspicion, red flags that you should be aware of and should raise your suspicion. Aftermath of an SCR, do you proceed with the transaction? Do you reject? Do you suspend? Do you stall? Do you exit the relationship? This is a decision that the company has to make. Another thing to highlight here is suspicious transaction reporting requirements do not begin only after you have got a customer on board, which means that even when you are potentially speaking to a customer, a prospect, and if you suspect that they're potentially doing money laundering, you are actually obligated to report that to the SDRO, CAD department. So make a sensible decision in terms of what you're going to do, but always be aware that you should not tip off the investor on the decision that you're going to be filing an SDR. Now, this slide, I thought I'll give you an idea of AMLCFT amendments and trends. As I mentioned in the beginning of my presentation, MAS is going towards the direction of name and shame, where if they find that companies are not adhering to AML KYC standards, enforcement actions will be published, and MAS is also issuing out higher penalties as well, not just to banks, but also to other type of financial institutions such as fund managers. So in terms of what MAS has done, they have strengthened the penalties for offences, for sure. Penalties for failing to report SDR and tipping off offences have definitely increased. They have strengthened the government's ability to enforce and prosecute offences relating to money laundering and terrorism financing, especially if the acts are committed abroad. MAS and Singapore government has also joined hands to share more information with other jurisdictions in terms of financial intelligence. So they have endorsed the ACMON Charter and Principles for Information Exchange to collaborate and make sure that syndicates, money laundering activities which are happening around different jurisdictions can be investigated more efficiently. There is a new MAS anti-money laundering department that was set up, so which means that there is a dedicated resource to enable the MAS to go there and inspect different companies and do industry-wide inspections. So most recently, I think MAS did an industry-wide inspection on external asset managers, a type of fund managers, to identify the gaps that they find is prevalent in that particular area of fund managers. MAS is also working with a lot of industry partnerships, so they're working with a lot of banks in Singapore as well to come up with different standards and protocols. MAS is also doing more thematic reviews, meaning industry inspections. Again, recently they released a thematic review report that they conducted on fund managers and the use of fund administrators to help them in doing AML KYC checks, which is why I touched on that much earlier on. And MAS is also using AI data analytics capabilities to monitor and detect money laundering more efficiently. So I think overall the sentiment is that, number one, please have a look at your policies and procedures. See if what you're doing, is it sufficient? If you're using a third-party service provider, like the fund administrator, understand what they are doing and whether that's compliant and whether that's sufficient. If you have identified gaps, do not wait for a long time to rectify these gaps. You should be proactively reaching out to your investors to help bridge some of these gaps that you have identified. Of course, you can reach out to service providers like us, to help you make sure that you're on the right track when it comes to AMLCFT, because this is not something that's going to go away anytime soon. In fact, the importance and the focus from the regulator on this particular area is going to increase, and that's my view. And as we all see, it's not just a Singapore trend. This is, effectively a global trend. Everyone is trying to do their part to reduce money laundering, which reduces terrorism acts, because 90% of terrorism financing, terrorism acts are carried out through laundered money. So I think keep that in mind, and I think we have come to the end of the presentation. This is what I've already covered in terms of the thematic inspections, in terms of outsourced service providers using fund managers using outsourced service providers to help them do the various AML KYC checks. Okay. So now we will come to some of the questions. Okay, so we've got one question from Stephanie. How often does FATF assess and release the list of countries under call for action monitored jurisdiction? Stephanie, unfortunately, we are not sure how often this is done. So what the regulation here says in the notices and guidelines is that financial institutions must regularly check the FATF website. For example, Myanmar, when I last checked, which was, I think, 6 months ago, was not really in the monitored jurisdiction, but it has somehow come into the monitored jurisdiction category when I last checked, which was very recent. So what I normally recommend is to check the FATF page at least once a month. Just do a general quick check and make sure that there are no changes in terms of the jurisdictions. Another question we have, CDD 3 to 1 year based on risk legend. Is this full CDD similar to onboarding time CDD or ongoing monitoring questionnaire? So for high risk customer, it is mandatory to repeat the entire thing at least once a year. When I mean entire thing, it means that you have to go back, collect the documents, you have to get the verification documents as well, and repeat the AML screening. But for low-risk customers, it is not explicitly stated in the guidelines by MAS whether you need to repeat the full scale of CDD. But our view and recommendation is, if within the 3 years of, if there are no changes, I mean, what I'm saying is that it's quite a simple process to go back to your customer and ask if there's been any changes. If they don't come back to you, and if you're not aware from publicly available sources there are any changes, then your next step is basically just to repeat the AML screenings. So as far as possible, go back to the customer and ask for updated documents, even if it's for medium or low risk customer, and then do the AML screening, repeat it, and then update your CDD risk assessment form and make sure that you don't override what you have already done. Okay, let me scroll down. What are some examples of screening tools? The ones I've come across, KYC 360, Dow Jones, which used to be Dow Jones, and then you've got Thomson Reuters as well, which was used to be called World Check. These are some of the main ones that we have seen. Another question, in regards to money laundering, if an investor subscribed into the fund, filled up bank account A in the form, and then decided to redeem the fund out and invest money into bank account B, is this possible? So if that is a request, you would have to verify for yourself if that account does indeed belong to this person, and whether there are any other beneficiaries belonging to the account. And you have to justify and put a file note to understand what is the need for the redemption to go into a different bank account. from my understanding, most fund administrators who help to do the redemption do not permit this. But I think as long as we can prove that the account belongs only to this person and there's no other beneficiaries involved in the account, then it should be fine. This is an interesting question. I often find it a challenge to query the source of funds from customers. Where does the line cross from due diligence to invasion of privacy? I think the moment someone decides to become a customer, there shouldn't be a question of privacy anymore. I've always heard people say, customers, don't want to give this document, don't want to give that document, but I think they should be aware that in most financial jurisdictions, in all countries, in any type of financial relationship they're going to have, customers need to provide these documents. In a lot of countries, KYC documents and all have become standardized. It's almost, in a database that every financial institution can have access to. So I think privacy should not really matter here, as long as you are able to satisfy the risks that you're taking with having the customer on board and the documents you have. That is what you should be thinking of in terms of doing your due diligence. Okay. What's the example of normal CDD? Basically, normal CDD effectively means you do the whole full spectrum of checks, the identification, the verification of all the entity, the individuals, the natural persons, the shareholders, the authorized signatories, and the ultimate beneficial owners. That is effectively what a normal CDD is. And then anything which is a high risk, you do more than what you normally do, which is get additional documents on source of funds and source of wealth, get it approved by senior management, and subject them to higher AML screening. And then you have the other spectrum, which is low risk. If you have a listed company, you don't need to get, you won't be looking at UBOs. You don't need to get, directors, verification documents of a listed company typically, because listed companies and all, they will have annual report that you can take most of the information from. Of course, UBOs is not something that you need to look into. For regulated companies as well, as long as you can show where they're regulated in a low-risk FATF country, general information about who the individuals are in the company, the directors. You don't have to obtain UBO identification verification or even passport copies of directors for a low-risk type of customer where you've done simplified due diligence. One question is, I seem to imply that we are only required to obtain updated documents from high-risk customers. If passport copy of low-risk customer has expired, shouldn't we also obtain it? Yes, you should. So what I was trying to say is, it is mandatory to repeat all of the KYC process for a high-risk customer. For a low-risk customer, where you're repeating the checks once every 3 years, as I mentioned, it is best to make sure that all documents are updated and you don't have anything expired. It is an easy process to go back to the investor and ask if anything has changed, especially if it's a corporate entity, and then repeat the AML screenings on all of the natural persons as well as the entity. So to answer your question, yes, you should obtain expired documents. You should not have a KYC of your existing client where a passport copy is expired. And in most cases, fund administrators do help to track that as well. So be ready to be aware and check with your fund administrator on their process for this as well. An employee may suspect, but if management does not conclude that way, is it obligatory for the company to file SCR? Can the employee do their own filing without informing the company? Yes, the employee can do their own filing. If they suspect, then you are doing your job. If the management does not conclude that way, what all companies need to do is they have to maintain a suspicious transaction reporting log. So the log or the register should have all the information of who escalated what is the decision made, when was the reporting done, if it was reported, if no police report was lodged, even though it's a fraud case, the reasons for why, and then to STROCAD, when was the lodgement done. So everything has to be documented. If the management decided not to report, that should also be documented, because this is one of the things that the MAS and the auditors will look at when they come in for a audit or an inspection. Okay. Maybe I'll do one more question. When we assess the client risk for corporate entity, we should focus on the domicile of the entity or beneficial owner, especially when we identify the FATF country. We have to look at both where the entity is domiciled as well as where the UBO is domiciled. If one of it is from a high-risk FATF country, our recommendation is to classify the entire client as a high-risk account and do enhanced due diligence thereafter. Okay, I think that's it. We've come to the end of it. Apologies if we are not able to answer all of your questions. Just to give you an understanding, we at Argus Global will be happy to help you guys with any issues you have. We do help to conduct AML screenings. We do help to also look at enhanced due diligence for your investors. As an outsourced compliance service provider, we also do sample reviews of our customers, of our clients' customers periodically, to make sure that the processes adopted by the customer, processes adopted by the fund managers or the financial institution, as well as what the fund administrators or the other outsourced service providers are doing, are they sufficient? Are they accurate? We help to review those, and we help to make sure that if any gaps are identified, we help to rectify those gaps. So if you guys need any help, please reach out to us, and we'll be happy to chat. As a reminder, we will be sending you the quiz link. Please help to complete the quiz, and we will be looking forward to sending you all the certificates for attending and completing this successful training. Please do keep a lookout on our social media sites as well as on our website for upcoming trainings. We are looking forward to doing a similar session on AML as well as other related topics as well in the coming months. And lastly, I hope everyone managed to find this session useful and practical as far as possible. I think that's what we tried to bring across today. And yes, thank you everyone for joining me today and for joining Argus Global. Thank you.